Welcome to Manifested Publishers. My name is Mr. Mariga Bernard, and I'll be teaching you Advanced Management Accounting. Specifically, the topic I want us to talk about is the topic known as planning and decision making. Once we cover planning, or one of the items we are going to cover planning and decision making is this particular subtopic known as CVP models under conditions of uncertainty. CVP models under conditions of what? Uncertainty. In our previous session, we talked about CVP models in under conditions of certainty, where we said under conditions of certainty, the factors affecting cost volume profit analysis are known with certainty. Some of these factors include the selling price per unit, the variable cost per unit, the fixed cost, the units produced and sold. These factors that affect CVP are known with what? Certainty. But there are those circumstances when these factors may not be known with certainty, where the user of information may not be certain or may not be sure about the selling price of a product. They may not be sure about the variable cost of a product. They may not be sure about the fixed cost. They may also not be sure about the demand that our customers are going to demand for a particular what? Product. When the factors affecting cost volume profit are not known with certainty, we introduce the concept of CVP models under conditions of uncertainty, what sometimes we also refer to as stochastic models of CVP. Stochastic models of CVP. For us to study these CVP models here under conditions of uncertainty, we are saying it is where one or more factors affecting CVP and profits are not known with certainty. Are not known with certainty. Certainty. For us to be able to deal with CVP models of uncertainty, we must be given probability. Probability in terms of chance. You may be given the probability of selling price, of various selling prices, the probability of various variable cost, the probability of demand, and so on and so forth. These probabilities are normally obtained from prior experience of the user, from previous observations. So allow me to introduce one of the methods that we are going to study as far as this particular topic is concerned. The first method I want us to talk about, or among the methods, let me write here, let me just highlight the methods here, then talk about each one of them. Methods of under conditions of uncertainty. Under conditions of uncertainty. So these are the methods we normally use to study cost volume profit analysis, or the relationship between costs, volume, cost, profits, revenues in relation to the volumes, number one. The first method is what we refer to as expected value method. That is the first method. The second method that we will use to study this is simulation method. Simulation. We may also have sensitivity analysis. Sensitivity analysis. Number 4, statistical analysis. Number 5, probability tree. Diagram method. Then continuous or normal distribution method. Normal distribution methods. Normal distribution method. So these are the various methods that we are going to study so that we understand CVP, where one or more factors affecting profit and CVP is unknown. So number 1, let me start by highlighting this method known as expected value approach. The expected value approach of CVP analysis. The expected value approach. Now, expected value simply says or simply states that the expected value is determined by taking the summation of probability, you multiply by what? X. Where PO means your who? Probability. And X may be your observation. Maybe your who? Observation. Or your variable. Let me also refer to it as your what? Variable. This variable here may be demand. This variable here may be the units. This variable here may be the profits. The variable may be the costs. Okay. So to get your expected value, you're going to take your probability, you multiply by your variable. The expected value can be denoted, can simply be denoted as X bar. The expected value is denoted as what? X bar. So we can have an illustration. Let's have an illustration on this approach known as expected value method. And the question I want us to talk about today is a question on November of 2017, question 4A. If you go to your KASNEB past papers, and we go to November 2017, question 4A, question 4A. And they're saying 4A, that company is known as BPO Limited. It is known as BPO who? Limited. BPO Limited. So BPO Limited is planning to launch a new product into the market. In order to determine the introduction selling price of the product, a market research was undertaken. The following information was obtained from research under two selling prices, 300 and 350 per unit. The selling price per unit, or 300 shillings, you have your probability of 0.4, and the unit sold are 120,000. Probability of 0.5, and the unit sold are 110,000. probability of 0.1, and the units are 140,000. When the selling price per unit is 350, with a probability of 0.3, your sales volume is 108,000. With a probability of 0.3, your unit's sales volume is 100,000. With a probability of 0.4, your sales volume is 94. Additional information number 1. The variable production cost would be 120 shillings per unit for production volumes up to and including 100,000 units each year. However, if production exceeds 100,000 units each year, the variable production cost per unit would fall to 110 for all units produced. Advertising cost would be 9 million per annum at a selling price of 300 shillings and 9.7 million per annum at a selling price of 350 shillings. Fixed production cost would be 4.5 million per annum. Advice: the management of Beepo Limited on the optimal selling price per unit for the new product. Advice: the management of Beepo Limited on the optimal selling price per unit for the new product. So this particular question here requires that the user or the students to advise the company on the optimal selling price that that company is going to set. The first selling price is when you have a selling price of how much? 300. The second selling price is when you have a selling price of how much? 350. So let's start with the first option. Let's start with the first option. Option 1. Let me call it option 1. When your selling price P is how much? 300 shillings per who? Per unit. 300 shillings per unit. To determine your profit, say it is P minus V, you multiply by Q units minus what? Fixed cost. That is how we determine our what? Profit. Where P is your selling price per unit, V is your variable cost per who? Per unit. And Q are the units produced and what? Sold. Units produced and sold. F is normally your total what? Fixed costs. Your total fixed costs. Currently, they want us to analyze when we have a selling price of how much? 300. We need to go and see and identify whether we've been given the variable cost. And additional information number 1. Additional information number 1 is saying the variable production cost would be 120 shillings per unit for production volumes up to and including 100,000 units each year. However, if production exceeds 100,000 units each year, the variable production cost per unit would fall to 110 for all units that were done what? Produced. So for us to be able to determine our variable cost per unit, we need to determine the units that were produced and sold. The units that were produced and sold. Because the units that were produced and sold are influencing the variable cost, such that if you sell 100,000 units, your variable cost will be 120. Anything over 100,000 units, your selling price will be 110. Right. So let's determine Q units. We determine Q units. And how will we do that? We will determine the units that are going to be produced and sold by simply taking your probability you multiply by your sales volume. Your probability by your sales volume. Okay. So we're going to say 0.4 by 120,000 plus 0.5 by 110,000 plus 0.1 by 140,000. So therefore, the expected units to be sold at a selling price of 300, if you work this one out, it should be 117,000 units. 117,000 units. Therefore, now that we have the units that can be sold, we can then determine our variable cost. And they were saying for any units above what? 100,000, your variable cost will be how much? 110. 110 per who? Per unit. 110 shillings per who? Per unit. That is given by additional information number 1. We have the selling price, we have our variable cost, we have the units. Now let's determine our fixed cost. Note number 2, advertising cost will be 9 million per annum at a selling price of 300,000 and 9.7 million per annum at a selling price of 350. Fixed production cost would be 4.5 million per annum. Your fixed cost here will be given by your fixed production cost plus fixed plus administration overhead plus administrative. They are referring to them advertising, not administrative, advertising costs. Plus advertising what? Costs. Your fixed production overhead cost is 4.5 million and your advertising cost is 9 million. So therefore, your total fixed cost is 13.5 million. It is 13.5 million. Let's determine our who? Profit. Our profit. Your selling price is 300 with a variable cost of 110. You multiply by the units, the expected units, which we have determined as 117,000 minus your fixed cost of 13.5 million. Minus your fixed cost of 13.5 million. Therefore, for that company, or when that company sells or sets its selling price at 300, they expect to sell how many units? Or 117,000, and to make a profit of 20.88 2880,000, rather 7380. Let me confirm this again. 300 minus 110 times 117,000 minus 13.5 million, 8730. 8730,000. All right. Let's go to the second option. Option 2. When you set your selling price at how much? 350 per unit. When you set your selling price at 350 per unit, we must determine our units. We must determine our expected units to be sold. by taking the probability times the units. So you're going to take 0.3 times 108,000 plus 0.3 by 100,000 plus 0.4 by 94,000 by 94,000. So 0.3 times 108,000 plus 0.3 by 100,000 plus 0.4 by 94,000. So therefore, the expected sales volumes, the expected sales volume is how much? 100 what? 1,000. 100,000. It is always good to confirm that whatever you've done is what? Accurate. Always confirm. Once you've determined our units, we then determine our variable cost. Note number 1, the variable production cost would be 120 per unit for production volumes of up to and including 100,000. So this will be 120 per unit. Your fixed cost is the next item you're going to determine. It will be 9.7 million, which is your advertising expense given by note number 2, which says advertising cost would be 9 million per annum at a selling price of 300 and 9.7 million per annum at a selling price of 350. So since our selling price is 350, the fixed advertising cost will be 9.7 plus your fixed production cost of 4.5 million. So 97 plus 45. That should give you a total fixed cost of 14.2 million. Of 14.2 million. So therefore, your profit should be a selling price of 350 minus your variable cost of 120. You multiply that by your expected units to be sold 100,000 minus a fixed cost of 14.2 million. Of 14.2 million. Of 14.2 million. So let's determine our profit. And the profit in this case will be 8.8 million. 8.8 million. 8.8 million. Then they are telling us to advise the company on what selling price they should set. On the selling price they should set. Remember, we had two selling prices that the company is considering. A selling price of 300 and a selling price of 350. When they set a selling price of 300, where they expect to sell 117,000 units, they are going to make a profit of how much? 87.30, compared to when they set a selling price of 350, where they expect to sell 100,000 units, they're going to make a profit of 8.8. So when we advise them, We're going to tell them to set a selling price per unit of how much? 350. When you set a selling price of 350, you're going to set how much? You're going to earn a what? More profits. More profits. All right. That is the first method of evaluating what? Of evaluating what? CVP models under conditions of uncertainty. Under conditions of uncertainty. The expected value approach. We've said the expected value is simply the product of your probability and your variable. And remember, we've said your variable may be the units, your variable may be the variable cost per unit, it may be the fixed cost. It is basically that unknown item that affects your profit or CVP. Let's go to the second concept. Let's go to the second concept that we have covered. Let's go to the second concept, which is what? Simulation. Which is simulation.